Happy Friday out there, folks. This is Darius Dale here to present our macro minute for Friday, May 6th, 2022. No matter what path your P&L has taken to get here, the most important thing you can do today is reallocate your focus budget to the next play. So, starting with asset markets, we have stocks down this morning, commodities mixed with crude oil leading, crypto down, dollar flat, global bond yields up. Shifting gears to our market moving headlines, we're going to get a lot of them today, starting with the April jobs report. All eyes on the ongoing upward pressure on wages and sort of the reduction, the structural reduction in labor supply, getting an update on that. And then we got a slew of Fed speakers today: John Williams, Neil Kashkari, Raphael Bostic, Chris Waller, my man, two guns, James Bullard, and Mary Daly. They'll all give their take on where they think interest rate, the neutral rate lies, and whether or not the Fed is appropriate to be more aggressive, particularly with respect to the terminal Fed funds rate and the neutral rate. So be on the lookout for that because that is what's mattering to markets right now in the course of this week. Shifting gears across the bond, the ECB may raise rates above zero this year. Francois Villeroy said, ECB Governing Council member. He said officials should conclude bond purchases at the end of June, which would be a necessary precursor to hiking interest rates. Yet Israel Schnabel out effectively said rate hikes may be needed to ensure consumers don't lose faith in the ECB's inflation fighting power. So now you got a bunch of central bankers who last year were dead wrong on inflation in terms of their forecast, but now they're sort of trying to make up for being dead wrong, as all good humans do in terms of our behavioral fallacies and our limitations. They're now trying to make up for the mistakes that they made last year while being blind to the mistakes that they're probably going to make in 2 to 3 quarters from now. So that's an issue. But as it relates to sort of risk assets broadly, keep it. And then one last thing, an interesting nugget this morning. Or actually, sorry, two things. One, well, we'll unpack a lot of these sort of data points in our leadoff morning note today as relates to the kind of the evolving outlook for both Fed and ECB policy. And then lastly, we had an interesting nugget here. I saw this on Bloomberg. Said that it's this worst first 4 months start to a year for the S&P 500 since 1939. That's a long ass time ago. Part of my language. So I looked up at what did stocks do over the ensuing 8 months. It doesn't matter. Who cares? It's 2022. Stop focusing on everything you should not be focusing on and focus on the growth cycle, where we are in that, the inflation cycle, where we are in that, the liquidity cycle, where we are in that. Are investors positioned for, not sentiment? I'm not talking about sentiment readings. Are they positioned for appropriately for where we are in those cycles? And everything else will everything else will make sense from there. So just make sure your focus budget is adequately focused and tuned in, because this is no market for people who are unfocused and doing the wrong things. Big movers this morning: Shanghai Composite minus 2.2%. Definitely not looking like a market that's stimulating. It's down 8.6% month over month. Bitcoin down another 2% to down 18% month over month. Ethereum minus 3% to minus 17% month over month. We sold our Bitcoin Ethereum back in early April. Had a nice trade, caught a nice trade from mid-March to early April, and it's been straight downhill from there. Taking it to the charts this morning, looking at our volatility adjusted momentum signal and probable range processes. US dollar still bullish FAMs. We got minus 1.8% of downside versus 1.4% of upside in its probable range. Gold still neutral VAMs. You got minus 1.7% of downside versus 4.4% of upside in its probable range. It's just really struggling here with the concept of the Fed potentially taking rates, quote unquote, beyond neutral, as Powell confirmed on Wednesday. 10-year nominal Treasury bullish FAMs here. It's now back up on the move here. It is hitting new highs this morning, minus 30 basis points of downside versus 16 basis points of upside. What is the level where things start to break? Are things already breaking? We would argue they are. We've talked about this in our mortgage rate analysis, our credit yield analysis, our private sector debt leverage analysis that we've been discussing our leadoff morning notes and macro scouting reports. So nothing new for those of you who are adequately prepared and or have a 42 macro subscription. High yield OES broke out to bullish FAMs this week. Now it's got a lot less pressure to the upper boundary of its probable range. There you get 23 basis points of upside with 52 basis points of downside there. S&P 500 bearish VAMs minus 5.1% of upside versus 6.3% of downside. So fair fight. Neutral VAMs, somewhat of a fair fight in the VIX, although it's a little bit skewed to the upside, to the downside. Minus 42% downside versus 11% of upside. NASDAQ 100 bearish VAMs minus 6.6% of downside versus 8.6% of upside. Russell 2000 still bearish VAMs minus 6% of downside versus 6.8% of upside. I mean, you just kind of looking at the chart, there's the momentum to the downside in the NASDAQ is actually a little bit worse than it is in the Russell. And that tells you that this sucker right here is still extremely, extremely crowded. There's so much market cap, so many people with their secular growers and their high quality compounders, and you got to take a crowbar and pry these companies out of people's hands and portfolios, and that's why you've seen the relentless selling pressure year to date. Even though, guess what? The reverse repo's got $2 trillion of liquidity in it. Yikes. Bitcoin bearish VAMs minus 6% of downside versus 13% of upside. All that excess liquidity is not helping Bitcoin. All that excess liquidity is not helping Ethereum at all either. You got minus 9% of downside versus 12% of upside. So guess what? Maybe it's not just the reverse repo and all the plumbing. Maybe the actual cycle where we are in the growth and inflation cycle and how the Fed's responding to that might actually have an impact on financial markets. Just hypothesis. I kind of got that from a guy named Ray Dalio, just kind of built the world's biggest hedge fund. So no, just a hypothesis. Minus 5.9% of downside in Shanghai Composite versus 4% of upside. I got a lot of hypotheses these days. You let me rant, I'll rant. You guys saw me on Real Vision on Wednesday, and thanks to everyone who viewed that rant. And all the wonderful feedback. It's certainly something I thought I've been having it on my chest for a really long time, and I finally articulated it well, and it finally made a lot of sense. Not only in the context of what was happening in the market, but certainly in the context of a lot of the thoughtful discussions I've been having with some really incredible investors. I've learned a lot of stuff about a lot of stuff this year, and it's all been really helpful to the process. So appreciate everyone who's contributing. But getting back to the probable ranges, so I can let you guys go here. Minus 14% of downside versus 3% of upside in crude oil. Ag here, neutral VAMs still correcting off the upper boundary of its probable range, minus 1.6% of downside versus 4.6% of upside. And then lastly, spin a second here. Industrial metals look like they want to break down to bearish VAMs. I mean, we've been on this nice linear ascent here, kind of getting to the point of note, the point of truth here on industrial metals. This is two things. One, it's going to be the most economically sensitive of all the pockets of the commodity market. So is this presaging a sharper deceleration in demand destruction? Or is it just sort of reacting to China being shut down and it's potentially ready to V bottom and bounce in the coming weeks and months as China reopens and starts to turn on the liquidity spigot a little bit more than they have in recent quarters? I don't know the answer to that yet, but I do know what the chart looks like today, and I do know the levels that'll trigger a bearish VAMs breakdown. So stay tuned for that. So with that, Darius Dale presenting our macro minute for Friday, May 6, 2022. Best of luck out there, and have a great weekend. Cheers.